items. Under that, the first item that we are taken up is inventory. See, tomorrow we will be taking up on to property, plant and equipment. Though we intended to hold it only for 1.5 hours, if the discussion is expected to go a little further, I think you should not mind for another 15-20 minutes. Now let us just take up, select balance sheet items. Under that, the first item is inventory. So we understand that inventory types are such that the normal expectation that we carry normally would be 3 items: raw material, work in progress, and finished goods. But here we will be having firstly under inventory, retail inventory, that is trader, where he would or the entity will be buying and selling. So there is a first type. See, there can be 2 types of businesses where inventory will be there. One is trading, the other one being manufacturing. If you take up manufacturing, the first of its type will be for raw material. The second will be that of work in progress, and third one will be that of finished goods. So people might just feel that inventory is a topic which is very easy and all that. To them, I wanted to tell you it is not to be taken up as a very easy topic, not to get frightened that it is very tough. But thing is that you got to give due respect to certain things which I will be taking up for discussion. Of course, in the regular class, I just made that as a discussion, but we will try that. So, what are the items that we will have as a focus other than this normal inventory? Is that we would like to know whether goods in transit will be taken up in whose books, whose responsibility the inventory would be. And when you have goods in transit, so quite naturally, the businessman, the vendor will try to finish off the sale at the point of his factory or depot. The responsibility of taking delivery will normally be rested with the buyer. But that is a general statement. But there can always be something special where you can say free on board. That means the vendor takes up the responsibility of boarding it to the place of carrier transport. It could be surface transport, railway, or lorry. It could even be through marine, or it may be airlifted. So the point of sale, they will decide free on board at what point. Sometimes what will happen is that free on board destination. So it is not at the place of vendor and free until the stage it is delivered to the buyer. So if the vendor takes up the responsibility, revenue will be recognized only upon delivery. So until such time, it will be goods in transit in the books of the vendor and not in the books of the buyer. So you got to be a little more careful when it comes like that. Non-conforming goods. From the very name itself, you understand that non-conforming goods would mean you would have ordered A, they would have delivered A, B, or some other item X, which may be resembling, and quite naturally the buyer will be rejecting. So until it is accepted as their goods, so quite naturally these non-conforming goods will not be considered as a sale, that will be taken up as a stock from the viewpoint of the vendor. So always remember wrong delivery. Wrong delivery in the sense it's not to the wrong person delivery, wrong item delivered. So though it will be looking like any other transaction or sale had happened, and we will strictly say that moment it had just gone, it has become a sale. That is all correct only when it is a appropriate product. When it is a non-conforming goods, it is not a sale at all. Once again, the status of that non-conforming goods will be that of goods in transit. So until it is returned, it will not be considered as the inventory of the buyer. It is only the inventory of the seller. Next one, consignment goods. So quite often you find the business getting expanded. You find the principal will be in one location and the agent will be in another location. Goods will be transported, but will not be considered a sale. When the sale point will be taken up, only when the agent is selling, that is the time at which sale is made. Until such time, it is a stock of the principal lying at consignee's place, and quite naturally, inventory would include all those items. Next item, public warehouses. See, sometimes what will happen is that the goods are imported or kept for export in certain warehouses. So it all depends on, normally on behalf of the vendor, these items will be stored in outside locations. Say, why outside locations? Say, there can always be convenience for the businessman to give delivery from warehouse rather than picking it up to his factory. So when the sale will be considered as effected only when it is taken delivery. Until such time, those goods are lying only at a different place under a different custodianship, but it will be considered as the inventory of the vendor. I hope that these points are clear. Then guaranteed buyback. What do you mean by guaranteed buyback? Say I deliver and charge and I get the money. The buyer, will have a right to effect a sale of that particular item back after 2 years, 3 years and all that. So if such be the case, the title would have got transferred, delivery also they would have made, but it will not be considered as sale at all. So these are all sham transactions. What do you mean by sham? These are all looking like a sale transaction, but they are not sale transaction at all. So let me explain this way. Company A delivered to company B. Company B took delivery and paid consideration also. 3 years later, company B will effect a sale back to A at a price different from that of what was initially agreed upon. So whether this item will be considered as a sale, whether it will be taken up as an inventory, answer to that question will be the negative, no. So it is purely a financing arrangement only. I will give you another case also. Mr. A delivered his land and building to bank for $100,000. Let me repeat. Mr. A delivered his land and building to a bank. By registering the document, full value was taken, $100,000 he took. 3 years later, Mr. A would buy the land and building back for 175,000. 3 years, 4 years, or as the case may be, as per the agreement. And that sort of arrangement is nothing but a financing arrangement. What do you mean by financing arrangement? So A took loan for 100,000, repaid the loan as 175,000. So the banker wanted to secure the money, and therefore they've insisted that this sort of arrangement should be made. Otherwise, the loan will get defaulted. So when you have this sort of arrangement, which is looking like a normal purchase and sale transaction, but the essence of that, it is not a sale at all. It is not a buying at all. It is not an inventory at all. So when you have this guaranteed buyback, we would only consider that the transaction is sham, that is, it is all void, and you consider that it is not a transaction at all. It is not an inventory at all. So sometimes we get across this sort of transaction, we should have the courage to say that it is not a transaction at all. Installment sale. So installment sale is also I would say it's a financing arrangement only. Until ownership and delivery is given completely, it cannot be considered as a sale at all, right? So as how guaranteed buyback we have just taken up same day. Okay. Now one moment, I will just make arrangement here. So we have method of costing. Somebody is just keeping the say. Please put it on mute mode, please. Right. So first in, first out, it is method of costing. It is not about physical movement of material from the place of sale, or sorry, from the place of sale. It is not about physical movement. It is only method of costing. The first entered material cost will be used for issuing, that will be captured for cost of goods sold, and the balancing figure will be for closing inventory. First in, first out. Then next one is last in, first out. The rate at which you book your issues will be the last in rate, and the earlier material rate will continue to be there as part of your inventory. Average stock. So what do you mean by average stock? So in Indian scenario, we used to have simple average and all that, but in US GAAP, they do not take it up for discussion at all, this simple average. So where you have weighted average only, they call it out as average cost. So one need to know that weighted average is what they call it out as average cost there. The next one is the retail inventory. So right at the very initial stage itself, I told you that inventories can be identified into two. One, retail inventory, the other one, inventory coming under manufacture. So this method of costing is applicable when there is a retail inventory held by the company. I hope that things are. The next one, departure from cost method. So we were all taught from the earliest point of our commerce education, that is from higher secondary, that inventory should be valued at cost. This is what we have learned. Correct. But there are some exceptions that we have, especially that exceptions are very much connected to US GAAP. And possibly we might overlook thinking that the inventory topic by itself is very easy, and possibly we would not have given proper focus. So here is a place where I wanted to tell you that precious metals and some agri products are valued always at NRV, that being above cost. So that is the reason as why we have titled as departure from cost method. And when we have just done that, artificially we will be booking extra profit, and that has got to be conveyed in the financial statement in the form of a disclosure. Let me repeat, it is not applicable to all items. It will be applicable to gold, silver, and that sort of precious metals, and some of the agricultural products where they are valued only at NRV, that is being above cost. So inventories of gold, silver, etc., when there is a effective government controlled market at a fixed monetary value. So when business is being operated, quite naturally in all places, the government intervention will always be there, or there will always be a monitoring work government will be doing. And in some places, it will be government controlled market only they will be having. So because when you find private operators there, they work in the form of a cartel, and they will try to influence the price which will affect their currency. So therefore, these sort of precious items, government controlling monetary values will be there. There you can have at NRV. So therefore, you are very much guaranteed, and there is no scope for any risk associated with that. And therefore, you keep it up only at NRV, both opening inventory as well as closing inventory. The only item that you would be taking up in your computation is purchases, the inventory that you are booking at that actual price. So agricultural inventory, mineral satisfying all the following criteria shall be valued at NRV. What are those? It has got immediate market at quoted price. So people will not be hesitating. Say, whenever we talk something about a particular price, where you find all over the place the same price would mean people will not be bargaining, and people will effect the transaction only at quoted price. Is that right? So where you have differential prices, people will try to negotiate and try to bring things to their advantage. Next one is unit interchangeability that you have. What do you mean by unit interchangeability? Similar products only will have that unit interchangeability. So if I have one plus mobile, one plus mobile on that particular model, 100, 200 numbers you will be having. So I would just say it is not good. So I will return and I can take something else. So there is no uniqueness, and this is applicable only for when products are similar, or I would just say identical. Then inability to determine the cost. What do you mean by inability to determine the cost? People might ask this question, sir, just now you told that purchases will be made only at cost. No, natural minerals and all that, there is no cost that you have, that you get associated, because the money was paid in the form of rights. Extraction cost only will be considered. Can you consider extraction cost as a cost? So we need to amortize for the depletion of the rights, and it becomes a little challenging to arrive at the cost. So only in places where you find this cost is indeterminable or which will be challenging, for them it will be giving a comfort that it will be made only at NRV. So please just understand, there can be a theory question that you would be having. So they will be asking which are all the items that will be taken up at NRV, and they might just give precious metal, they will give you agricultural inventory, and they will give you minerals, and they will be giving something else. So you need to identify which one is correct and which one is incorrect. Depending upon the question as whether they are asking for incorrect one or the correct one, you got to take decision. Then this is what we would have learned in our higher secondary, cost or NRV, whichever is lower. Or possibly at the higher secondary, we would have heard something about cost or market price, whichever is lower. So at the stage when we entered into CA, there they would not have used the term market price. We will take it as cost or NRV, whichever is lower. So in CPA, it is not cost or NRV, whichever is lower alone we have. We do have cost or market, whichever is lower. So therefore, whatever we have learned in higher secondary is of no waste. We will have full utility of that, but let us just know about what is cost or NRV, whichever is lower. What do you mean by cost? Cost would mean the purchase cost, the money that you pay to the vendor minus the trade discount. What do you mean by trade discount? So as you offtake a higher quantity, the unit price might come down. So right at the very initial stage, they would have booked at gross. And at a later stage, when you are buying greater quantity, you are eligible for trade discount. And they will be sending a separate document for that. So where initially you would have booked at gross, and you find that discount, that being a trade discount for higher offtake, definitely there could be a reduced value, and that reduction has got to be deducted. And a freight cost, if any. Say, in fact, if you consider that if it were to be a normal exclusive freight cost, then you can take into consideration. If it were to be heavy, and when it is considered to be a routine matter, not exclusively for that particular inventory, then you can leave inventory also. So it all depends on as far as freight is concerned. The next one is NRV. People would like to know what is net realizable value. So it is a selling price minus the cost to complete and dispose of the inventory. So normally this NRV concept will be coming only for finished goods. For raw material, work in progress and all that, it is basically valued only at cost, because there is no intention to sell my raw material what I bought. But that does not mean raw materials are not taken up for this sort of scale of cost or NRV, whichever is lower. So generally speaking, NRV would mean we will closely associate that with finished goods. We do have NRV concept even for raw material also. Say, how come? I just bought some amount of material, raw material, and after my purchases, the price of raw material had dropped. Should I value the raw material less, or continue to value only at the purchase cost, which happened to be on the higher side. So it so happened for me when I bought Honda. There is Honda Basic. When I just bought 3 months later, there was a new model car that was there. So the price of the existing model, the old model, dropped. So likewise, there can be a scenario where we would have bought the inventory and on the valuation date, that is on the reporting date, the price would have come down. So there we need to take up whether the purchase cost will continue to be there or the new replacement cost should be considered. That we will discuss separately. So do not get the wrong impression that NRV is closely associated only with finished goods. I would just say it is generally associated with finished goods, also getting associated with raw material also. We will discuss that a little later. Current replacement cost or replacement cost is expected cost to buy the same item on a valuation date. If the same item what we have bought at a higher price, if the same were to buy to be bought on the balance sheet date, that is going to be a current replacement cost, or simply you can call it out as replacement cost. So I am using the term current replacement cost, but US GAAP is communicating that as replacement cost only. So do not get, I would just say, misguided. So though current replacement cost is a Indian way of calling that, in US GAAP they are calling it out as replacement cost. So the practice of calling certain things in a particular way, I could not stop that from doing it. So therefore I've used current replacement cost, but in US GAAP it is only replacement cost. Cost or NRV base shall be applied on all inventory not costed under LIFO or retail inventory method. What do you mean with that? Cost or NRV, whichever is lower, shall be followed only in the case of FIFO and weighted average. That is average method. So instead of saying that this is applicable only to FIFO and weighted average, they have put it in the negative way. Cost or NRV base shall be applied on all inventory not costed under LIFO or retail method. So next one is that cost or market base shall be applied on all inventory under LIFO or retail inventory method. So now what is the difference between the last two statements? See, now you can consider that FIFO and average method, for them cost or NRV, whichever is lower. So in the case of LIFO and retail inventory method, cost or market, whichever is lower. So you can take it like that. So have that in your mind. Okay. I hope that these points are very simple for you to take it up. So cost or NRV rules not applicable when the subsequent selling price. This is not the one that we were talking about in the previous slide. This is something different. Cost or NRV rules not applicable when the subsequent selling price is not affected by the market value. So where we have already contracted with our customer that this is the price at which it will be delivered. The fall in the price is not going to affect us because we have predetermined the price. If such be the case, should we have to religiously follow for every fall in the price of the finished goods as cost or NRV whichever is lower? No. These are all exceptions, so you got to be very careful. Questions will normally be tested in majority of the cases only on the exceptional sites and not on the regular application of rule. So the company has a firm selling price contract with the customer, and subsequent selling price is not affected by the change in the market value. So in this particular location, cost or NRV which will not be having any role to play. Shall I proceed to the next one? Then cost or NRV and cost or market whichever is lower. Well stands for whichever is lower. How done? Method whichever is lower. All of you closely follow. Base. Under that, you have FIFO and average. Already 2 slides before I've just done that. Next one is that LIFO and retail method. So whichever is lower, cost or NRV whichever is lower. In this particular case, I have only this sort of template ready. So therefore, I have put it out like this way: cost or market, whichever is lower. Is that clear? So whatever we have just done 2 slides before, that is what you just find it here. Is that clear? Shall we proceed? Then is reversal back to cost from NRV and market possible? What do you mean by that? Imagine an inventory that was bought at $100. This NRV had come to 90. Whichever is lower would mean 90 is what I'm going to value. So on the next quarter, when I prepared this interim financial reporting, my NRV went up to 115. From what it was 90, it had just gone. The quantum leap was very great. Shall I take it back to 100 the cost? Cost or NRV? Cost would mean 100 and NRV now it is 115. So in one particular quarter, I have taken it up at 90. In another quarter, can we take it up at 115? Sorry, 100. The answer is no. See, in Indian scenario and as well as in Ind, there is IFRS, reversals were permitted. In US GAAP, it is prohibited. So in Indian scenario and in IFRS scenario, reversal of write-downs were all permitted. Here, prohibited. So prohibition order is made in US GAAP. So once written down, it is always written down. There is no scope for writing it back, reversing the write-downs. So under US GAAP, reversal of inventory write-downs are prohibited. Permitted in India, prohibited in USA. So I'm just trying to repeat that only to drive home that point. Okay, next one. Ceiling and floor when market price is used. So I hope that this particular background also will enable you to understand what is that meaning. This particular picture is coming up there. You could see floor, you could see ceiling. What is that? Ceiling is the maximum. Next, floor is the minimum, right? So all that people know. Sir, what is this, sir? Ceiling and floor you are teaching. It's not ceiling and floor I am teaching. I wanted to tell you what is ceiling, how to compute. I want to tell you what is floor because cost or market price, whichever is lower, cost or market, whichever is lower, for market, we do have something to communicate. What is that? Ceiling is computed with the help of NRV. That is, ceiling is equal to NRV. So whatever computation that you do for NRV, that NRV and ceiling are one and the same, right? Then ceiling itself NRV would mean your NRV is the highest value. Then what is the floor value? Floor is computed by deducting normal profit from NRV. What is that? Floor is computed by deducting normal profit from NRV. So when something is deducted from NRV, quite naturally the value will be lower. Correct? That is a normal thing. Now, that being floor is equal to NRV minus normal profit. These are all very, very important items. Based on this, we are going to solve some problems. Okay. How market value is computed. This is a fantastic piece and we are going to solve immediately after this one problem. When current replacement cost, okay, when current replacement cost is less than floor, market value is floor. Correct? Market value is floor. When current replacement cost is ceiling, market value is ceiling. So when replacement cost is lower than floor, it is floor. When it is replacement cost is greater than ceiling, ceiling. That means you understand why we have just referred these two extremes as ceiling and the floor. When current replacement cost is between floor and the ceiling, Current replacement cost is the market value. Very, very, very important. Now, as I told you that I'm going to take up an example out of this. The following information pertains to a company's inventory at the end of the current year. The company uses last in first out. The company uses last in first out would mean it is cost or market, whichever is lower, or people put it out as lower of cost or market. LCM is what they call. Correct. Now, for the first item, cost is 20.5, replacement cost is 19, selling price is 25, and cost of completion in $1, normal profit is 6. I would like you people to communicate as what should be the answer for the first one. What should be the answer for the first one? So now let us just arrive at ceiling. Ceiling is equal to NRV. NRV is equal to selling price minus cost to complete. So 25 minus 1, which is equal to 24. What is floor? Floor is equal to NRV minus normal profit. NRV is 24, normal profit is 6, so it is 18. So you have 18 and 24. Your current replacement cost is 19. It is 19. Okay. So go back to this. When current replacement cost is between floor and ceiling, then current replacement cost is the market value. What is the next one? What is the answer for this? Answer is 19. So this is going to be market value. Are you understanding? This is for item number 1. For item number 2, ceiling, 30 minus 2, 28. In this particular case, 28 minus 7, 21. And this being 20. So you have 21 and 28, whereas this is 20. If that be the case, 20 will not be taken up, 21 will be taken up. So answer to that question is 21. 21 is market. Am I right? Are you following, all of you? Say yes or no. Because I find it is one-way traffic. Are you following? Srini, Bharat?
Sir, I can explain it again.
Huh?
Sir, the first point, no, like item
Who is
number
this?
1, Ranjani.
Ranjani. Yes. Tell. So let me explain. For the first item, see, whenever you have this sort of problem coming up, no. So apart from that, you just take up what is ceiling, what is floor, what is the replacement cost. Depending upon you arrive at this market price, cost, and the final value. So for the first one, I consider selling price 25 minus 1, 24. Right. Floor is going to be NRV minus normal profit. 24 minus 6, 18. Replacement cost is 19. What was the rule that we were having? What was that we were having? When current replacement cost is between floor and ceiling, Current replacement cost is the market value. Now tell.
So 19
So
is the CRC.
now
Current.
you have 19 is the market price. Your cost is 20.5. So between the two, whichever is lower is 19. Correct? Ranjani, are you following?
Understood. Yes, sir.
Right. Super. 2. Next one, ceiling is 30 minus 2, 28. 28 minus 7, 21. Replacement cost is 20, which is not in this range. So therefore, floor is what I got to take up. That is that being 21, and cost is 26. And between the two, whichever is lower, 21 is the answer. Correct? If you want as why we have taken up between 20 and 21, I would like to roll back here when current replacement cost is less than floor, 20 is less than 21. Correct? Therefore, market value is floor. Correct? Have you understood? So if that be the case, 21 is what I've chosen. Correct? And 26 is the cost. Between the two, 21 is the value. Are you clear, Ranjani?
Yes, sir.
Bharat, Srini, and
Clear.
Anup?
Yes, sir. Yes, sir. Yes.
Third. Now, 15 minus 1, 14. 14 minus 3, 11. And it is 12 here. And it is falling between the two, so 12. But cost is less than the market price, so 10 is the cost is the value for the inventory. Is that clear? Say yes or no?
Clear.
4. 60 minus 6, 54. 54 minus 4, 50. Replacement cost is 55. Now, replacement cost is above my ceiling. So, ceiling is what I will be taking up 54. My cost is 40. I will take it up at 40. Is that right? Say yes or no?
Yeah.
Anup, Ranjani, are you following? Srini, are you
Yes, sir.
following?
Yes.
Yes, sir.
Srini, are you there?
Yeah.
Are you
Yes.
in a position to follow?
Yes, Murali.
Right. So this example is a very important example. Not that it is very difficult. That is what I'm telling you. No. Say it is not difficult. Same time, don't take it easy. So whatever the devil is asking, give the devil its due share. Automatically, it will become your servant. Example 2. See now, this is a matter. The following information pertains to a company's inventory at the end of the current year. The company follows what? FIFO. Calculated the lower of cost or NRV. It is not LCM, it is lower of cost or NRV, whichever is lower. Now, we are expected to arrive at the lower of cost or NRV. So this is a simpler version only. NRV is going to be 27. Cost is 28.5. NRV is 27. The final value is going to be 27. Correct?
Yes.
In this particular case, the NRV is going to be 22 and which is greater than your cost. So the value of that is going to be 21. So in the first case, it is 28.50 versus 27, whichever is lower, 27. In the second case, it is 21 versus 22, whichever is lower, so 21. Correct? Say yes or no. Are you clear?
Yeah, clear.
Now, I would like to have a discussion with you as what do you understand from periodic method of keeping inventory, then perpetual method of keeping inventory. What do you mean by that? So you people would be definitely be having good amount of um, what should I say experience in your own field. Though we may not really be knowing the difference between periodic method and perpetual method, but at some point of time you got to make a intelligent guess and bring out the discussion. See, after all, it is our class. We have we can take things for discussion. Okay, come on. What do you understand by periodic method and the other one being perpetual method? Yes, yes.
The periodic method is nothing but where inventory is accounted at the end of the period, say a month on a monthly basis. Perpetual is more a continuous basis, the inventory is accounted.
Okay, correct. So in periodic method, it is done as a batch process offline. They stop every activity or they will do once in a month or once in 3 months, once in 6 months. That frequency they will decide. So they will do after every period. The period may be fortnightly or maybe 1 month. That is what. Perpetual method, from the very name itself, you can consider that it is a continuous process. And you can say it is online. So when you have 20,000 units of inventories had originally cost 5, you are required to pass journal entries to record the sale using periodic method, perpetual method. Can you just tell me what is a journal entry that you would be passing? If you have periodic method, if you have perpetual method. See, based on the method of keeping your inventory, your journal entry also will change. So don't get the impression that it is going to be the same for both. Understood? So can you guess what could be the scheme of journal entry that we would be passing? It is about not for purchases. It is all about a sale. What is the entry that we would be passing for the purpose of effecting the sale? Please. That is why I'm telling you, even when we would not have discussed this in the regular class, possibly I'm utilizing this amount of space and try to bring about a lot of interest on the subject. Come on. Come on, come on. What is the journal entry that we are going to pass for sale?
For the sale, you sold 20,000 units of inventory for $7. So $140,000 is the revenue that's credit, and then
In both the cases, it is $140,000.
yeah.
But what are the
And
account heads that you would be using for debit and credit?
for the cost of goods sold, it's going to be $100,000, and then the balance will go towards the.
No, no. Yeah, see, Sree, the question is about past journal entry for the sale. That's it. Rest of the matter of computing 20,000 into 7 is not a big issue. Now, let me just come out for your discussion
Yeah,
because we are
cash
all
account,
debit cash.
cash to sale, right? Murali?
You have to
Debit
give me
cash
answer.
to
Don't
sale.
ask me question.
Yeah. Credit revenue.
This is the journal entry that you would be passing for periodic method. Correct. 100% correct.
Right.
Under perpetual method, what is the answer that you would be passing? That is, what is the journal entry that you would be passing? So now let me just tell you what is the entry that we will be passing. Debit cash 140, credit revenue sale 140, and we will not stop here. You got to be very careful. That is the reason as why they are giving you original cost and all that. So here is a place where you need to know as what journal entry that you need to pass. Debit COGS 100,000 and credit inventory 100,000. See, when you pass this journal entry, you should automatically pass journal entry immediately. See, what happens is that in periodic method, we book only sale. We do not book cost of goods sold immediately. Please understand, this is a solitary journal entry that we pass. No journal entry for the corresponding cost, that being COGS. Say, can you just use your mic only when you are speaking? Okay, so I'm just hearing noise. So no journal entry for the corresponding cost, that is COGS. So sale will be happening separately. Purchases, manufacturing cost will be done, and your inventory will be taken care at the last whenever there is an inventory taking. So whereas in perpetual method, it is not like that. For every purchases that you make, the corresponding cost will also be taken up and journal entry will be passed. So what is that journal entry that we have passed additionally? The COGS, debit and credit is to be given to inventory. Are you clear? Are you understanding this?
Yes, thanks.
Right. Now, example number 4. So in fact, I will just go back to example number 3 itself. I would like to pose one more question. So here they are asking about what is the entry for a sale. So here I would like to make for purchases, what is the journal entry that you would be passing? Come on. I'm just making a small change in the question. Tell me what is that you should do.
Purchases to cash.
Purchases, debit,
Yeah. Credit cash. All right.
Correct.
Yeah.
Debit purchases, credit cash. Correct. Here, what is the journal entry that you would be passing?
The second one, you will debit the inventory.
Super. So debit inventory and credit is to be given to cash. That's it. That being the reason as why inventory is credited when sale is made and debit is given to cost of goods sold. Remember that when we have passed a journal entry under perpetual method, this was the scheme of journal entry. So when I am offering credit to inventory, I should have debited at the time of purchases. So therefore, what method of accounting they follow will decide upon what journal entry and what account heads that you got to use. Shall we proceed to the next one?
Yes.
Now, example number 4. During the first year of operation, A corporation has purchased all its inventories in 3 batches. Batch 1, 4,000 units at the rate of 4.25 per unit. Batch 2, 2,000 units at the rate of 4.50 per unit. Batch 3, 3,000 units at the rate of 4.75 per unit. 4,000 units were sold. 3,000 after the first batch and 1,000 after the second batch. Determine the amounts of closing inventory on COGS using FIFO and A, that is under periodic method, under perpetual method. Now you can understand what is periodic and what is perpetual. Can you just close this answer? I will give you 2 minutes time. I will just keep my video off for a moment. So I will just give you 2 minutes time and please just complete. Take your calculator and operate. Yes.
Yeah, the first one, the closing inventory is first in, first out. I'm just giving you only for the first one, $9,500 of the closing inventory value.
So let me just check up. So I have not made any calculation here. See, all of you closely follow. The closing inventory and COGS under FIFO periodic. See, 4,000 units were sold. Would mean this 4,000 would have got issued.
Correct.
So whatever value that you get. So first one, closing inventory, 2,000 into 4.5, 3,000 into 4.75. Both put together,
23
it is going to be 23,250. Correct? So whichever period at which it was affected as a sale, in periodic inventory, I will take into consideration this way only. I will not go out for matching at what point of time these items have had occurred. So therefore, cost of goods sold is nothing but the first batch which I bought 4,000 into 4.25. There is going to be 17,000. This is COGS. This is closing inventory. Correct? So please just keep your mic in mute condition. Okay. So this is the answer for periodic. For perpetual, I need to redo entire thing. As how they had occurred, I got to do. So receipt, issue, balance. The first one is 4,000. I bought it at 4.25 and 17,000. Inventory 4,000, 17,000. Second one is sale. 3,000 units were sold 4.25. So 3,000 into 4.25, 12,750. And it will be 1,000 and 4,250. Third one is that purchases made second time. 2,000, 4.75. Sorry, 4.5. 9,000, 1,000 and 2,000, 4,250, 9,000. Then fourth, sale made 1,000, 4.25, 4,250, 2,000 and 9,000. Correct. Fourth one, purchases for the third time. 3,000, 4.75. 14,250, 2,000 and 3,000, 9,000 and 14,250, 23,250. So our answer that we have developed, same. All of you, please be careful. This is not going to be the same for all the methods. So therefore, there can be a MCQ possibility. They'll be giving you periodic and perpetual. COGS and closing inventory they will provide. They will provide same number or a different number. You need to know. Unless you worked out, you will not be in a position to answer. Let me just challenge you. Unless the person is working out, he will not be in a position to get the correct choice. He may be an expert in all other matters, but unless he works out, he will not be in a position to crack it. Am I right? Are you understanding what I'm telling? I'm just not challenging anybody. I'm just only complimenting people who are working hard. So I'm just coming down heavily for those who are, I'm not talking about this group. I'm generally talking about, so do not take it easily. Work out, find out, and analyze and keep that in your memory. When question is coming, you will be in a better position to click the correct answer with the least amount of time getting spent. Example number 5 is the same, but what is that they are telling? Weighted average. So I would like to take up, there is moving weighted average. Say I wanted to take up LIFO immediately after that. Correct? Are you understanding? So now I roll back. I go to the same example. So here, instead of FIFO, LIFO is what I got to operate. Can I tell that my COGS and closing inventory would be the same for both periodic and perpetual? I hope my question is clear for you. So under FIFO, COGS and closing inventory, periodic and perpetual. COGS and closing inventory. FIFO basis. 17,000, 23,250, 17,000, 23,250. For LIFO, can you try like that? Can you try like that? Now, what is that you understand from LIFO? Last in, first out. So what we would consider as last in, first out, in between whatever that had happened in the month, we will not take up. So we will total up here as 9,000 units. 4,000 units gone. 5,000 units there. What is that? Mentally, we will be just be prepared for which part of 5,000 should be there. So 4,000 gone, 5,000 there. So which part of the month it was sold after first batch, second batch? This I will not run at all in my mind. So out of 9,000, 4,000 units gone, 5,000 is there, would mean I would say, can you just keep it? Say, please just keep your mic in mute mode. Say, my focus is only on the class. I just don't want distraction. So of 9,000, 4,000 units were sold. So last in, first out would mean, one moment. Last in, first out would mean last entered item has gone first. 4,000 units sold would mean this 3,000 units not there, and another 1,000 from the previous batch they would have utilized. So thereby our mind would just say of this 5,000, the oldest item is continuing. 4,000 I am continuing at 4.25. The other 1,000 is coming at the rate of 4.5. My mind will just go like that. So what is your COGS under periodic? So 3,000 into 4.75 and 1,000 into 4.5. Are you understanding? So 3,000 into 4.75 and 1,000 at 4.5. All that together it comes to 18,750. What should be my closing inventory? Closing inventory. My closing inventory will be the oldest inventory of 4,000 bought at 4.25. The other 1,000 which had just come out of the second batch. So 4,000 into 4.25 and 1,000 into 4.5. So it is going to be 21,500. Correct? 21,500. See, all of you, you need to be a little more careful as how these numbers are worked out. So you can affect a total. What is the total that you would be finding? 40,250. This is also 40,250. How much of your cost is allocated to cost of goods sold and how much to closing inventory? That is what we are looking at. FIFO and LIFO, the total will be same, but the distribution values will be different. If you have perpetual system, how this is going to work? How this will work? I will just give you. So this is the way it is going to happen. So when sale is made, there was only one batch. FIFO and LIFO is going to be same when you have only one type of inventory. So this is going to be same. And my purchases will also be the same. But when the sale of 1,000 is taking place, here I will not make it out at 4.25. What is that I will be doing? What is the rate at which I will be doing? I will take up the latest one, 4.50. Am I right? Yes or no? Are you following?
Yes,
And it is 4,500. And here it is going to be 1,000 of the oldest stock 4,250. The other 1,000, 4,500 you will be having. And 3,000 at 4.75, 14,250. So here, how this item will appear? 1,000, 1,000 and 3,000. 4,250, 4,500 and 14,250. What is the total that you would be getting? 23,000. What will be your cost of goods sold? Cost of goods sold is going to be 17,250. So here it will be 17,250 and 23,000. So your total will continue to be 40,250 only in both the cases. Look into your FIFO. Periodic and perpetual will be same. LIFO, you can't tell. What is that? You can't tell. By what point of time, what item you sold and all that will be a very big matter. So these are all equal. These are not equal. I mean, look at the numbers. Correct? They are not equal. So there can be a question that they will be asking. So what sort of question they will be asking? Ending inventory and cost of goods sold are same, whether a periodic or perpetual inventory system is used, applicable only for FIFO. What is that? Can you just take note of whatever I'm just telling? Can you make note? Let me dictate. Closing inventory and the COGS shall remain same, whether a periodic or whether a periodic or perpetual inventory system is followed. Is that clear? So weighted average method and all that, I would like to take it up a little later. Are you clear? Can one of you summarize what we have just learned? Sree, Anup, Ranjani, Bharat, Balaji. Can you just tell what exactly you have just understood on this periodic and perpetual and a FIFO, LIFO?
Yeah, under FIFO, both under periodic and perpetual, the COGS and the closing inventory value remains the same.
Is it cost and cost of goods sold and carrying and there is closing inventory will be same, or what is it you are trying to convey?
The value of COGS and closing inventory separately will be same. That's what I meant.
Yeah. So if you say like that, then it might just carry a different message. So the sum of all the inventories when you take up, it is going to be same, whatever may be the method. But thing is that the split values will continue to be the same. The split values of COGS and closing inventory will be the same for both perpetual, both periodical inventory system as well as in perpetual system, which you cannot be expecting in other methods of costing. Only for FIFO costing, that will hold good. For all other items, it will not be holding good. Is that okay? Are you clear? Anup, can you just tell in your own words?
Sir, if the method of valuation is LIFO, then whether the inventory is valued valued based means method of what is your computation is based on periodic or perpetual. The closing stock value and also the cost of goods sold will be one.
Separately, they will be same.
Yeah.
Srini?
Yeah, a table can be formed under three headings. FIFO, periodic and perpetual, the cost and the split values is going to be the same. And the LIFO, they are going to be different.
Okay. See example number 5. Please
Also,
put it on mute.
we understood better on the meaning of perpetual inventory and
Periodic.
batch.
Super.
Yeah, periodic,
Super.
very important. That's the
Right.
main distinguishing that we learned today.
Yes. So what is that we understand in this particular case for weighted average? Say weighted average. See, normal weighted average is one thing that you have. Moving weighted average is also another thing that you have. Okay. So this normal weighted average is going to be periodic. Moving weighted average is perpetual. I will tell you as how it is to be computed. So it will be very interesting. So one and only when you start working out a lot of problems, you will get to know, oh, this much is there in inventory. Now let us just take up periodic weighted average. So I take batch 1, batch 2 and batch 3. Their values I capture. 17,000, 9,000 and the last one is 14,250. 14,250. 250. 40,250. I consider the number of units being 9,000. Number of units 9,000. So I arrive at cost per unit 40,250 divided by 9,000. How much it comes to? It is 4.472222. So now the figure of 40,250 need to be split. 4,000 coming under COGS, 5,000 coming under closing inventory. Into 4,000, 17,889. This comes to 22,361, right? This is the way we do periodical weighted average. Nothing wrong you can tell in this particular method. Am I right? Say yes or no, are you in a position to understand this?
Yeah, this is what we normally do. I mean, when
Yeah,
we do
I
the
know,
inventory.
I know. This is what we consider as weighted average under that periodic. So 17,889 and 22,361. 22,361. 40,250 you get in perpetual. Can you get the same? Can you tell? Will you get the same answer?
Yes.
No is the answer. No is the answer. Now I will tell you how. Now I would like to take it up. Say when I have only one batch, when I am having 3,000 units to be sold, that 4.25 will be the answer, whether it is FIFO, LIFO or weighted average. This is perpetual weighted average. So up until this moment, it is going to be same. So now, so here, what will happen is that I will take up this number as 3,000 and the total is 13,250. And I would like to arrive at a rate. Are you understanding? Are you following? Srini?
Yeah, Murali,
So
can you come again, please?
4.4167.
Okay.
Say perpetual weighted average system in which purchases will be is booked batch number 1 and the rate is going to be 4.25. That is the rate I've used for the purpose of issuing 3,000. Say when you say weight would mean there should be many to say as weight. When you have only one, you cannot apply weight there. So FIFO and LIFO is going to be same. Correct. The next issue is done only at 4.25 that I've just done. The case is becoming interesting only when you had the second purchases at a different rate of 4.5. So by taking the earlier one of 4250 and the new one at 3,000, both put together is giving me a total value of 13,250 with 3,000 units. And the per unit cost is 4.4167. Do you agree with me? Srini, are you following?
Yeah, I said.
But I could not hear you because you are under mute. See, now what we will do is that for this issue, 4.417 I will make it. So therefore, this becomes 4417. So what would happen to my quantity is going to be 2000. From 3000, 1000 gone, and 13250 minus 4417. If I do that, it comes to 8833. By dividing 883 by 2000, what I just get is 4.4165. Because of the rounding off that I'm just making, it comes that way. So that doesn't matter much here. So what is going to happen is that 2000 is continuing to be there as 8833. This 3000, 14,250. I have 5,000 units. Now the value is different. 25,083. So 25,083 divided by 5,000. So it comes to 5.0166. So now when I want to update here, and here what is your COGS? It is 12,750 plus 4417. That comes to 17,167. I go back to this particular location and update it here. So where I'm just getting 17,167, and here it is 23,083. 23,083 is what I'm just getting. Am I right? So now I'm just having a different sort of impression now for LIFO, weighted average. Are you understanding?
Yes, interesting.
Right. Are you clear? Ranjani, Balaji, Anup, Bharat,
Yes, sir.
please let me know. Are you following?
Clear.
Clear. Okay.
Yes, sir.
So that is the difference in weighted average for periodic and perpetual. That moving average I've already done. Okay. This LIFO also we did. Now we have come to MCQ. I think by 7:30 we should be getting it over. Anyway, I would like you people to take it up. Come on, one of you please just read out. Srini.
Yeah, if opening inventory is understated by $26,000 and its closing inventory is overstated by $52,000, what impact it has on cost of goods sold? A, B, C, D, understated by $26,000, overstated by $26,000, understated by $78,000, and overstated by $78,000.
So your cost of goods sold equation comes like this way: opening inventory plus purchases minus closing inventory, which is equal to COGS. Because the question is about COGS. So where it is understated by 26,000 and overstated by 52,000. So what sort of impact it is likely to cause for COGS? The sum that I have to include, I have included less. The sum that I got to deduct, I excessively deducted. What these two mistakes would have caused on my COGS? Is that okay? Supposing you are
Yes.
supposing you are not clear. Sir, I'm just not in a position to visualize all this properly, sir. No problem. So you take up correct figure and actual figure. Opening stock, you take it up as correct figure is 126,000, and here you have taken about 100,000. So 26,000 understated. No, I have taken 26,000 understated. Purchases, a convenient number, you can take it up 800,000. There is no problem in this. Closing inventory overstated by 52,000. So 152,000, I'm sorry, 100,000, correct figure. Here I have overstated 152,000. I have to deduct. What is my COGS? Say, if you feel like, say, I'm not in a position to visualize, why not you crack or take one example and then operate 126 plus 800 minus 100. You get 826, correct amount. What is it you will be having? 100 plus 800 minus 152. 748 is what you would be getting. I think you can mute it, please. So 78,000 is the difference. Whether it is understated COGS or overstated COGS. What it should have been 826, now it is 748. Whether I have understated my COGS or overstated my COGS, and by what amount? Come on, simple one only. Come on, make it fast, make it fast. Make it fast, make it fast. Are you there? COGS is understated or overstated by 78,000. COGS is understated by 78,000. Are you clear? I expected a very fast answer for this. Now, if opening inventory is understated by 26,000 and closing inventory is overstated by 52,000, what impact it has on its income? So please be careful. What question that they asked for COGS? Same question, same alternatives, but instead of COGS, now it is on income.
Or stated by 78,000. Option D.
That's it. That's it. So you cannot be telling, sir, in the last problem you have chosen C, and in the same question, please understand where the impact they want to measure. They want to measure in COGS or income. That is what you got to look at. Okay. So now, not much that is left. You can just try this. LMG recorded the following inventory information during the month of Jan 2024. LMG uses LIFO method to cost inventory. What amount should LMG report as inventory by 131, that is January 31st, under each of the following methods of recording inventory? So you have the information, what is the balance and how much it was purchased and at what rate and all that. So you need to tell how much is periodic, say this ABC or the alternatives. So this portion is a question, this portion is a question. So based on these two, you should be in a position to arrive at the correct one. So the method that they are using is LIFO. Can you tell? Come on. So just now we have just done one exercise about what is periodic and what is perpetual. But here, perpetual firstly, periodic later. Correct? Here you have opening stock and unit cost is given. And these two, when you multiply, you get this. So 1200 into 3, 3600, 800 into 5, 4000. But what is this? These are all units in hand. So this unit is coming up here after purchases. This is 2000 plus 1200. 1800 when you deduct from 3200, this is 3200 minus 1800. How 2200 is coming up? 1400 plus 800. That is the way you are arriving at. What is that question that they asked? So what is your closing inventory on the closing date? What is the inventory that you can arrive at for periodic and perpetual? Come on, tell. Are you clear? Now that you know what is periodic and perpetual, you should be in a position to crack it faster. Come on. It will not be taking much time. So therefore, 7:30 said a little extra time it will be taking up. That's it. Tomorrow we are doing it for PPE. So now inventory is over. So inventory class is getting over. If it were to be FIFO, no. Whichever alternative gives you the same figure for closing inventory, that is what you got to select. Are you understanding what I'm telling? Supposing this problem were to be FIFO, let us assume that if it were to be FIFO, imagine, okay, I need not just do this. I will select D and proceed. Understood? To select D, adequate amount of classroom practice we had. We have just completed that. So that means under examination condition, look into the method. Okay, if it were to be FIFO, then what is that you should look into? Perpetual and periodic, same number is there. That is what you got to select. I don't have to think there. Unfortunately, in this particular case, it is not FIFO. Are you
Now
understanding?
we have to choose among A, B, C, not D.
D. So you got to do that exercise. See, I'm telling you, see, whatever we do in the classroom, it may be LIFO. Under examination condition, same problem will come with FIFO. So don't waste time by working out. Straight away select D, and I'm damn sure, 200% sure that that is right. There is no other alternative where these two numbers are equal. Can you just check up? Oh, you have C also.
It's also
Excuse
same.
Same
sorry.
way, C
Yeah,
can be
C is
eliminated
also.
too.
Yeah.
No, I'm just telling you. Then I got to check it up and then tell. Okay, but anyway, I'm telling you, perpetual and periodic FIFO will be same. In rest of the cases, it will be different. They will be different.
Yes. Now we can toss
So
the coin for A and B.
now you can tell C and D will not participate at all. Why? Why C and D will not participate?
They are mutually
same.
exclusive.
They are same actually.
They
They
are
are
same.
same. 100 before.
What is our expectation? They should not be same. Correct?
Eliminate C and D.
Mutually
So
exclusive.
it's not mutually exclusive. Yeah, mutually exclusive. You can say to that extent. Now select between A and B. So
B.
anyway, see, I'm telling you, you can just go for screen capture and complete it. Okay. So that's it. Not a big deal.
Let us toss the coin.
The end of this class. Thank you. Okay. But anyway, I'm just giving you once again, you take a click, and what you do is that I would be feeling very happy if you give me the answer just in 5 minutes time after the end of the class. Okay. Will you do that?
Sir, actually, sir, Ranjini
Oh,
has-
got the answer. Ranjani, did you get the
for
answer?
periodic, yes, sir. For periodic, it is 5,400. Since option A periodic is 5,400, so
A. Then answer is A.
Sir, I feel B, sir.
B. Anyway, I will just check up. So, though I just said there is no rush for me to go, I can just work out for this. So if it were to be periodic, how do we just take up? I have opening, one purchases, another purchases. So if I take a ball that, it comes to 3,2 and 4,000. 4,000 and sold is 1,800. So 2,200, the earliest one I should be getting. The earliest one would be this opening stock. So it is 2,000 into 1, 2,000. So another 200 I got to pick it up from the next purchases of 3. So it is 600. So 2,600 should be my closing stock. So it is B. B is the correct answer. A is not correct. So now you can understand how you can eliminate C and D, how you can push through That B is the correct answer. Are you understanding? So what is very important is how to crack under examination condition, how to knock it off under examination condition with the least amount of time. So when you do this for MCQ, you can just balance it for task-based simulation. Imagine that if a person had not done this exercise, now how much time it is going to take? Extra bit of time, right? So invest all your times during this Saturday, Sunday class. So I have just come to this sort of conclusion. So instead of dragging, like SLG accounting, I just lost my PPT and took time and all that. So then I just felt okay. So we will finish one topic. There is no question of carryover unless it is very much required. So we will finish one class, one hit. That's it. Tomorrow we are going to take up on to PPE. What and all we will be having in PPE, I will tell you. It is a cost, 2 depreciation, 3 exchange transaction, number 4 impairment. So maybe tomorrow instead of 1.5 hours, it is going to be 2 hours. So don't miss the class. And by doing that, so that particular topic you can pack it. So that is what even in the main class, I would have just taken up a little elaborately. This particular class is just like Vande Bharat train. See, that may be a regular train. This is Shadabdi or Vande Bharat or Tejas. So that sort of class, it is not that we are going fast. So we are just knocking off, and the technique of cracking under examination condition is what we are just focusing. Okay. I hope that you are clear about how we are going to select amongst the alternatives. Go very well prepared and closely follow the class. Okay. So our regular classes in which I've just taken all this. But thing is that the juice content is what we are taking it up now. Okay. Thank you. And we'll be meeting tomorrow, same time, but for 2 hours.